If someone has an unfinished basement or an unused space over the garage, what's actually sitting there besides storage?
What's sitting there besides storage is a second income stream, if it's built and financed correctly. Most homeowners look at that space and see clutter. I look at it and see a rent check that could be covering half their mortgage.
Why is this such a live conversation for homeowners right now?
Because two things have changed at the same time. Zoning rules in a lot of cities have loosened over the past couple of years. ADUs that used to require a variance are now allowed by right in many neighborhoods. And separately, the major agencies now let lenders count a portion of ADU rental income towards qualifying income in certain situations. 5 years ago, neither of those was true. Now a homeowner sitting on unused square footage has a real financing path to turn into income, not just a home improvement project. And it's not just a cash flow play. An appraiser can often add real value to the home for having a legal, permitted second unit, separate from whatever rent it produces. So you're building two things at once, a monthly income stream and equity in the underlying property.
What's the biggest misconception people have about building an ADU?
Yeah, the biggest misconception they have is that it's a cash project. Save up, hire a contractor, pay as you go. Some people do it that way, but most homeowners don't have $80,000 to $150,000 sitting in savings for a garage conversion or a basement build-out. What they don't realize is that equity in their existing home and renovation-specific loan products can fund the whole thing. And in some cases, the projected rental income from the ADU can help you qualify for the loan that builds it. The other myth I hear constantly, a rental unit will hurt my resale value or make the home harder to sell. In most markets right now, it's the opposite. A legal ADU widens your buyer pool when you eventually sell. Multi-generational families, house hackers, investors, and appraisers are increasingly comfortable crediting that extra living space with real dollar value, not treating it as a liability.
Walk me through how someone actually finances one of these.
Well, there's three paths depending on where you're starting. One, a renovation loan, like a HomeStyle Renovation loan or an FHA 203K. These roll the construction costs into a single mortgage based on the home's value after the ADU is built, not before. One loan, one closing, one payment. HomeStyle's cap renovation costs at 75% of the after completion value on most transactions. FHA has its own limits as well and works well for buyers with less than perfect credit, though it comes with a mortgage insurance for the life of the loan. Two, a cash out refinance or a HELOC against existing equity if you have enough built up. You're using capital that's already sitting in the house instead of taking on a separate construction loan. This tends to be the simplest route if you have 30 to 40% equity because you're not tied to a renovation loan draw schedule and inspection process. Three, and this is newer and specific, as of this year, if the ADU is on your one unit primary residence and you're either purchasing or doing a limited cash out refinance, Fannie Mae will let a lender count a portion of the projected ADU rent towards your qualifying income. There are real limits on this though. It only applies to a principal residence, only on a purchase or limited cash out refinance, not a full cash out refinance, and not an investment property. And the ADU income that counts is capped at 30% of your total qualifying income on top of the appraiser using roughly 75% of the market rent to begin with. It's a real tool, but it's narrower than people assume when they first hear about it. The common thread across all three, none of this works without the numbers on paper. An appraiser has to be able to support the ADU's value. And if you're using rental income, find comparable rents in your market.
Give me a real example.
A homeowner had a full unfinished basement with a separate entrance already in place. A lot of older homes here do. She wanted to convert it into a one-bedroom rental but didn't have the cash for permits, plumbing, and a kitchenette build-out, roughly $75,000. Before we even talked financing, I told her to call the city first. Her lot was zoned to allow it. Permits took about 3 months to approve, and the contractor's timeline was another 10 weeks for construction. That whole process ran in parallel with the loan. We did a HomeStyle Renovation refinance, rolled the $75,000 into her existing mortgage balance based on the appraiser's after completion value. The appraiser used comparable ADU rents from 3 other properties within a mile to support both the value and the projected rent. Her monthly payment moved up by a modest amount, nowhere close to what she finished unit would bring in. The finished unit rents for $1,450 a month in her market. She had a tenant sign before construction was even finished because the contractor kept listing photos, updated as the space came together. Even with the lender only counting 75% of that toward her file, the actual cash flow once it was rented covered the entire payment increase and then some. She didn't touch her savings. The house paid for its own renovation.
What do people misunderstand about the numbers?
First, lenders don't count 100% of projected rent, usually 75%, to account for vacancy and expenses. So if the market rent is $1,500, your file shows roughly $1,125 towards qualifying income, not the full $1,500. Budget against the conservative number, not the optimistic one. Second, and this is the one that trips people up, an unpermitted ADU isn't really an asset from a financing standpoint. If it wasn't built to code with proper permits, an appraiser generally can't give it value, and a lender can't count rental income from it. The permit isn't paperwork. It's what makes the whole financial case real. And third, don't forget the property tax side. Adding finished, permitted square footage typically triggers a reassessment, and your property taxes will go up along with the value. It's usually a small fraction of what the rental income brings in, but it should be part of the math, not a surprise on your next tax bill.
What's the costliest mistake you see?
The costliest mistake? Building first, asking questions later. I've had homeowners finish an ADU with cash, unpermitted, because it was faster and they wanted to avoid the inspection process. Then they come to me wanting to refinance and pull equity out based on the new rental income, and there's nothing on paper to support it. The appraiser can't credit unpermitted square footage. The rental income doesn't count. They spent the money and got none of the financing benefit. So the key is check zoning and permitting first, then build, then finance around what you can actually document in that order, not the reverse. So there's 3 things you can do this week. Number 1, call your city or county planning office and ask directly whether ADUs are allowed on your lot and what the permit process looks like. Number 2, get a rough contractor estimate for what the specific conversion would cost. And number 3, call me with those numbers. I'll tell you which financing path fits and whether the projected rent in your market would actually help you qualify or just needs to be a cash flow positive on its own. Take the home loan quiz at teamaronheim.com or text me directly at 720-248-6892. If you've got space that's sitting empty, let's find out what it's actually worth.